Hello, in this video we will discuss what credit is, how credit works, and the benefits of having good credit. The MidFirst Bank Money Coach program is a partnership between MidFirst Bank and the University of Oklahoma to provide financial education to all OU students. Each of us has something that follows us our entire lives. It starts out blank, and over time it becomes either good or bad. If it is good, it opens doors. If it is bad, it can close doors for a long time. What am I talking about? Credit. Credit is the ability of a customer to obtain goods or services before payment based on the trust that the payment will be made in the future. For example, if you want to buy a home or a car, but you don't have the money to buy it, then you will need to borrow money from a lender. In order to borrow money, the lender will look at your information to determine if they trust you to pay back your loan. Before we dive into the details, I want to put you in the shoes of the lender. This is Reed. He saw your camera on Craigslist and he wants to buy it. He doesn't have $500, so he wants to pay you over the next 6 months. What do you need to know about Reed before making this decision? When qualifying for a loan, lenders consider your current income, how long you've been at your job and the stability of your job, the amount of debt you already have, your assets or what you own, and most importantly, your credit report. Even if all the other factors are positive, if you have a poor credit history, it could keep you from getting a loan or cause you to receive less than desirable terms, such as a higher interest rate. There is a cost to credit. Spending money that you don't have will cost you more later. Why? Because of interest. Interest is money paid regularly at a particular rate for the use of money lent. Essentially, the lender is charging you interest to let you borrow the money. The better your credit, the less you will pay in interest on loans. If you have good credit, it can save you thousands of dollars over your lifetime because lenders use your credit score to determine if it is safe to lend you money. If you are considered risky because you have poor credit, the lender can deny you credit or charge you a higher interest rate because of your poor credit. Let's look at how good credit can save you money. Everyone will most likely buy several cars in their lifetime. Let's say you pick out this hot pink little beauty. You want to borrow $20,000 for 48 months. If you have good credit, you might get a 3% interest rate, making your payments $443 a month. If you have a lower credit score, you might get a 14% interest rate, making your payments $547 a month. That's $100 more each month. The total cost of the 3% loan is $21,250. The total cost of the 14% loan is $26,250. That's a savings of $5,000 by having good credit. It makes an even bigger difference on a mortgage. Let's say you borrow $150,000 for 30 years. If you have good credit, you might get a 4% interest rate, making your payment $716 per month. If you have a lower credit score, you might get a 9% interest rate, making your payments $1,206 a month. That's $500 more each month. Your total cost of the 4% loan is $258,000. Your total cost of the 9% loan is $435,000. That's a savings of $177,000 by having good credit. We just proved that building good credit can save you over $200,000 in your lifetime. Having good credit can do more than save you money. Your credit report serves as a financial reference for companies and people with whom you want to do business. In addition to lenders, employers can check your credit report. Typically, a low score won't prevent you from getting a job unless you're not attempting to pay on your balances. Apartment managers will check your report when you apply for an apartment. Utility companies will check when you get utilities in your name. And insurance companies use your credit score as part of a formula that determines your premium. Obviously, we all want to save money. So let's talk about how credit works. Let's say you go into a bank and apply for a car loan. The lender pulls your credit report and grants you the car loan based on your credit score. The lender reports your new loan to the credit reporting agencies. Information includes amount of loan, type of loan, term of loan, and payment amount. Then each month, the lender sends a new file to the credit reporting agencies indicating your new balance, if you made your payment, and if it was on time. If you are making payments on time, then your credit will improve. The next time you apply for a loan, the lender will obtain your updated credit report. Thus, the cycle continues. Let's look at how it works for credit cards. First, you apply for a credit card. Then, the credit card company pulls your credit report and either approves or denies you based on your credit score. If approved, they will mail you a credit card. Each month, you make purchases with your credit card. It is important not to charge more than you can afford. We suggest charging small, non-emotional purchases like groceries or gasoline so you can afford to pay your credit card balance in full each month. When you are approved for a credit card, you will be given a limit to how much you can charge on the credit card. In this example, you will have a $3,000 limit. You will want to keep your balance below 30% of the limit, which means you cannot charge more than $900 on your credit card. Each month, you will receive a monthly statement from your credit card company. They will give you two numbers, a minimum due and your entire balance. If you only pay your minimum due, then your payment will most likely cover your interest payment, mostly just cover that interest payment instead of going towards the original balance. Let's look at how the interest can really add up. Credit card interest rates are high because it is unsecured credit. Typical interest rates range from 15% to 25%. The minimum payment is listed on the face of the credit card statement. Many people plan to pay more, but when they see the minimum payment, it's easy to fall into the habit of paying less than you intended. In this example, if you make the minimum payment each month, it will take you 16 and a half years to pay it off, and you will pay $3,200 in interest for a total cost of $5,400. If you committed to paying $100 each month, you can pay it off in 2.4 years. That's a long time, but much better than 16 years. Plus, it'll save you money. Buying things that we can't afford on credit ends up costing much more, which is why we recommend that you use credit cards to make small purchases that can be paid in full each month. Let's continue through the credit cycle. As you make payments each month, the credit card company will report it to the credit bureaus so they can update your credit score and your credit report. If you make your payments on time and keep your balance below 30% of the limit, then your credit score will improve as your credit score and credit report is updated each month. Credit is a huge part of our lives, so it is good for you to understand it. Now that you know what credit is, how credit works, and the benefits of having good credit, check out our video that goes over credit reports, credit scores, and how to build credit. If you would like to learn more, make an appointment with your money coach and I advise. If you do not know who your money coach is, please email us at moneycoach@ou.edu. We are located in the Couch Tower on the second floor. Don't forget to follow us on social media.